I just tested dozens of popular income ETFs using a brand new metric I created called the DRIP score, and the results completely changed how I look at dividend investing. One ETF yielded just over 3%, another yielded over 84%, and yet the lower yield ETF absolutely destroyed it in long-term wealth creation. I also found ETFs where taking the cash beat DRIP. High yields quietly held up incredibly well, and some extreme income strategies completely collapsed under their own NAV decay. And honestly, I think this reveals something most income investors have been missing for years. So stay tuned. Welcome back to Simply Money. Today we're diving into one of the most interesting investing projects I've ever built. Most investors assume reinvesting dividends is automatically the best move. But after running the numbers across dozens of income ETFs using the DRIP score and the income versus decay ratio, I discovered something surprising. Not all income compounds equally. Some ETFs quietly create incredible long-term wealth through healthy compounding, while others may actually perform better if you simply take the cash instead of reinvesting. In this video, I'm going to walk through 5 ETFs that completely changed the way I think about DRIP investing, and the contrast between them are honestly shocking. We're going to look at lower yield outperforming massive yield, high income with surprisingly healthy structure, situations where taking cash actually won, and what happens when NAV decay becomes too severe for DRIP to overcome. These are questions people ask all the time, and I created this tool to help you out with that. So let's jump in. So here's the Simply Money DRIP score and income versus decay ratio spreadsheet. If you'd like a copy of this is available down in the description below at Buy Me a Coffee. All of our spreadsheets are available there. This one combines all of the different DRIP sheets and then has this DRIP score and income versus decay score all in one place on a summary. This is a big all-in-one package. The individual sheets for like SCHD, QQQI, all of those individual DRIP sheets are still available for those who only want a particular ticker. But for those who are really wanting to do some deep diving research, this is a spreadsheet you may want to look at. But let's go ahead and look at these numbers for you so you can just watch along right here and see what we're talking about. The first one we're discussing is SCHD, and I know I can already hear a lot of the comments. SCHD has no business in an income portfolio. SCHD has no business being talked about with high income earners. Well, let's take a look at this, because this one is one of the biggest surprises in the entire spreadsheet. Now, SCHD only yielded around 3%, which looks tiny compared to many of these income ETFs. But the DRIP score was absolutely massive. Why is that? Because healthy NAV appreciation combined with dividend growth creates an incredibly powerful long-term compounding engine. This was the moment I realized higher yield does not automatically mean higher wealth creation. In fact, SCHD became one of the strongest examples of why healthy underlying appreciation matters so much more than many investors realize. It has a lower yield, but you add that with a healthy NAV growth, it can dramatically outperform extreme yield long term. And we'll compare this to SPYI, which is a high income with surprisingly healthy structure. But let's dive into SCHD a little bit here. You can see since inception, the price appreciation of 249%, its full DRIP total return of 449%. But I want you to come over here. You can see the 50% DRIP, the no DRIP total return, but the DRIP score. Remember, green means that dripping, you did way better. The percent you see here means that if you dripped, you did 100% better than if you didn't drip. Doesn't mean that not dripping was bad, because you want income. A lot of these, you want something that you can drip or not drip and still get a positive total return. And that's what we see right here. Whether you dripped it or did not drip it, you got a positive, a very, very strong positive return. But the other thing I want you to see is when it's purple, the 999 score, that means that there is no decay. The income versus decay ratio here, remember, decay. If it's green, red, or yellow, it means it has decay. Some, maybe not a lot. Green means it doesn't have a lot of decay and that its yield is surpassing the decay. So it has a higher yield compared to the loss that it's taking, so you can still get a positive outcome. But purple means there's not even decay in it. You're getting the yield, plus you're getting the appreciation of the share value going up. And so look at this, 100%. You have got a great score here. You can come down here to the 3 lines, and we'll scoot down. You can see all the different tickers that are available. We'll go to SCHD's drip sheet, and you can see on the drip sheet what's happening, when you bought it, how much you invested. Say we put 50,000 in. You can see each quarter when it paid, how much the distribution was, and it tracks all of this for you, and it updates automatically when a new distribution is put out. I'll come down here so you'll see this. So in June 2026, when the distribution pays, the date will automatically fill in here. The share price on that date will automatically fill in here. You'll see what the distribution for that month or that quarter is on SCHD, how much it paid you, whether you're dripping or not dripping, and you can keep track of your portfolio balance here, what the yield is for that particular quarter. As we come down here, you have the summaries, you have your total appreciation, the average yield that it's been paying each and every quarter. And again, this is from inception on this one. And so you can track all of these different things and see what's going on. But we really want to focus on this video on the summary sheet, where we're looking at when I'm deciding what to buy, we obviously want to be aware of what we're doing. If we have a drip score that is red, it actually means that you're better to take the cash. If we have a drip score that is green, we're going to get a better total return if it is green and if we drip. That is just telling you which one gives you the higher return. You could have a negative on both. You could be green, meaning your drip score is you're better off taking and putting it in drip and you'll get a better total return, but it may be a negative total return. And likewise, you might have red and say, okay, it's better to take the cash, but it may be a total return that is negative. It's just not as big of a loss as if you drip. And we'll look at that scenario in a minute. But SCHD definitely scored well. Now let's look at SPYI. This is where things started getting a little interesting. SPYI produces substantial monthly income. Right now, you're looking at about 12% yield. You can see that right here. The average yield is 12%. But unlike many high-yield funds, the NAV behavior was actually remained surprisingly healthy. You have an 8.65% price appreciation. Because you have appreciation, you see the income versus decay ratio. It is not decaying, so it's purple, meaning it's actually growing. The best scenario is green and purple if you're going to drip. And we'll look at some other options here. But this sheet gives you that ability to just do some analysis, one fund to the next. And so because of this, SPYI creates a much stronger drip environment than many investors would expect from a covered call ETF. Some people think all covered calls, you're better off taking the cash. Other people think you're better off dripping, and there's always more to the story. And this completely changed my assumptions because I realized high yield itself is not the problem. The real problem is uncontrolled NAV decay underneath the surface. And SPYI showed that a fund can still generate meaningful income while maintaining a structurally healthier compounding environment. Some high-income ETFs can support long-term drip if the NAV behavior remains stable. Let's get into something a little different. A massive yield with strong total return. We have a nice healthy yield here in SPYI, 12.14. But when you start talking about really massive yields, people automatically assume NAV decay. Before I go any further, can you guess what I'm about to say? Can you guess what ticker I'm about to show you that has massive yield and has great price appreciation? go ahead, throw that in the comments down below. And before you do that, let me say this is not financial advice. This is for informational and educational purposes only. Please do your own due diligence and know that all investments come with risk. I share this with you to provide tools for you, to provide the data for you. You have to do your own homework still, and everybody's investing journey is unique. Personal finances are personal. So understand the risk, understand your own risk tolerance, understand the goals that you have, understand your environment, your financial situation, what you're trying to accomplish, not what I'm doing, not what your neighbor's doing, not what some other YouTuber's doing. Know your situation. I only do this to provide tools for you. I'm not telling you what to buy or not to buy, because we're all in a different scenario. With all that said, don't forget, hit that like and subscribe button. It really does help the channel out. And here we go, the massive yield with strong total return. Did you put the right one down in the comments? CHPY. Since inception, 71% price appreciation. And look at the yield. The average yield has been 40%. This thing has been a monster. It has actually just been crushing it. Now, we know this is not going to sustain forever, but we are right now in a really strong place with CHPY. And that's the wonderful thing about this drip score, income versus decay ratio scoring, is that it will change. It is active. As things change, if the yield drops, if the NAV decays, these will update and change. So you can keep track, say, oh, maybe I better start dripping, or maybe I better stop dripping, or maybe I better get out of this fund altogether. It is going to help you monitor things, especially those that are borderline, the yellows. Those are right on the border. Could go green, could go red. We have to watch that. But CHPY, and this one has honestly shocked me. I bought in it back in like October, somewhere in that time frame. I had added some. I think in November and December, I've been just doing a little bit of buying here and there, but mostly just reinvesting my distributions. And look at that. It has got a high drip score, meaning 38% higher return by dripping. So I'm dripping this thing. I'm just getting that total return. My position is growing steadily, and it's growing fast. And along with that, I'm getting a 41% average yield. It has been a beast, because usually when you see these extremely high yields, and I'm just going to say it, especially from YieldMax, we're scared. You can expect significant long-term problems underneath the surface. But CHPY produced these massive incomes, strong total return, and surprisingly healthy drip environment. And this became one of my most fascinating examples in the entire spreadsheet, in my opinion. What are your thoughts on CHPY? What are your thoughts on these three so far? Throw some comments down below. Start the dialogue with one another. I'll try to get involved as much as possible. I always try to respond to comments and keep the dialogue live. And I appreciate all that you guys do in the community. But CHPY has showed that occasionally high yield and strong compounding can actually coexist. But this is also where investors need to stay careful, because the long-term sustainability of these strategies still matters enormously. Extreme yield does not automatically mean structural failure, but it can. And that brings us to our fourth. Which one do you think I'm going to show on the fourth one? Any guesses? I know some of you are watching and then you're going to put your comments in. It's okay. We do that, but put your answer in there. MSTY. That's the fourth one we're looking at. Let's look at this one. Look at that NAV decay, -43. But I want you to look right here. This is the indicator for you. And again, this is, it did bad. Dripping, 50% dripping, no drip, negative, negative, negative. But you see that your drip score is red. It means that taking the cash, you actually had a better total return. So that's your indicator. If you're going to be in this type of fund, for whatever reason, you're better off taking the drip. Yes, you're still in the negative, but you're 9%, almost 10% better total return by taking the cash. And your income versus decay ratio is very borderline. This is one, I would be honest, at this point, I would not get anywhere near this one. If I'm wrong, tell me your experience. Maybe you bought in it at a better time than inception. Maybe you bought in it at a better time than it's being shown here. You can go to the MSTY drip sheet down at the tabs down here at the bottom. You can change the date so you can see different scenarios. What if I bought here? What if I bought here? Does it ever get better? Does it get even worse? So you can run those different scenarios on each and every one of these tickers. As you can see, each ticker has its own drip sheet where you can run all the different scenarios. This one completely changed the way people deal with high yield investing. They see this high yield, look at that, 84%. They get all excited. 84%, I'm going to get in this, all the cash flow. And MSTY produced absolutely enormous income. The yield looked incredible. But despite all that income, the drip score still turned negative. That means even reinvesting those massive distributions historically failed to overcome the structural NAV decay. This was one of the clearest examples showing that yield alone does not guarantee successful compounding. Because eventually, if the underlying asset weakens fast enough, drip can become a losing battle. Extreme yield cannot always overcome aggressive NAV deterioration. And that, again, is why I've created this sheet for you to be able to look at this and score it and really visually see, you know what, this sounds good. This yield sounds amazing, but it's bad. And then you can look at CHPY and be like, oh, I don't want that. That high yield is just too bad. I don't want to get into it. And you're missing a massive opportunity because it is structurally sound. Now I want to look at one more example. And this is where we're going to see where it actually does well, but you do better by taking the cash. Any guesses on this one? Our fifth example. Throw the comments down below. What is your guess on this one? We're going with CONY here. Look at that, negative 66%. Negative 66%. You have actually been decaying like crazy. But look over here, your drip score, negative 24. This example means you do better if you take the cash. And over here, we're just barely in the red, meaning you have income that is not quite keeping up with the decay. But I want you to look at that. With doing a total drip, you're negative 16% return. If you did half drip, kept half the cash, and reinvested the other half, your total return would be negative 2. Still negative. But look here. If I took all the cash, I'm actually positive 8%. I have actually gained 8% by taking the cash. Even though the NAV's down 66%, I take the cash, I'm up 8% total return. Now, your portfolio balance would definitely be down. If you go to the drip sheet on CONY, we'll just jump over here real quick. Come down here, you look right here. This is how far down your balance is. Let me change this. I know people don't like the 500,000. We're going to put the 50,000 in. I invested 50,000 in CONY. Come back down here. If I dripped, my balance is $41,000. I have nothing to show for it. I've taken no cash. Unrealized loss of about $8,200. Now, if I did 50-50 drip, I have cash that I've been taking, but my total loss, remember, was negative 2%, and my balance is down to $26,000, so about half down. But you have cash to offset that. That's why your total return is better, because you've locked in that yield with the cash. But if you took the cash, remember, your portfolio is going down. You're down to $16,000. Now, if you're living on this, that's not very helpful. You get a few months of this, great, I'm getting this income, but my balance, my capital is being eaten away. I have nothing. Now, if you're using this to create income to invest in something else, or maybe you're using it, and some people do this, using it to pay a car note or whatever, and you're fine with the balance coming down and you're making those payments, I would be very careful with that. The best scenario with this is taking the cash and reinvesting it into something else, dollar cost averaging, but your total return is 8%, but your balance, your unrealized gains in this portfolio is down dramatically, and eventually this is going to go away. And you can see how with no drip, you're getting $4,000, $5,000. Look how this is dropping, $3,000, $2,300. Now that was monthly again. And then you're going into weekly, 600, 500. So it's slowly going down. Let's come down here to the end. Every week now, you're only getting 300, 233 this week. So you might be getting 800, 900 a month versus 5,000 when you started, because your balance is dropping. When you're looking at these, you need to consider all of these scenarios. I just wanted to show you that you can have a negative appreciation, but a positive total gain if you're doing it the right way. If you were just dripping, you'd be down 16%. But if you were taking the cash and maybe you're putting that somewhere else, you're up 8% and you're buying into whatever else you're buying into and it's doing better. CONY becomes one of the clearest examples where taking the distributions as cash actually outperformed DRIP. And that's a completely different conversation than most dividend investors are used to hearing, because most people assume reinvesting is always better. I had a comment recently on a video. Someone said, yeah, no kidding, DRIP is always better. No, it's not. Sometimes it is. Usually it is, but there are several scenarios in here. You can look at this sheet. There are several that it's better not to. Look at the red on this column, DRIP score. If it's red, it's better to take the cash. So in this case, continuously reinvesting into a rapidly decaying asset historically hurt long-term results. And this is exactly why the DRIP score became so important, because now we can finally separate attractive income from healthy long-term compounding. Sometimes taking the cash can actually produce better long-term wealth outcomes than DRIP can. Now, after building this spreadsheet, I honestly think the income investing world needs to start looking beyond yield, because not all income is created equally. Some ETFs quietly compound wealth for years, while others may slowly destroy compounding underneath the surface despite these huge distributions. And now, instead of just asking, what's the yield? I'm asking, is this income actually creating long-term wealth? That's a very different question. That's it for today. Thank you for joining me. We'll see you next time on Simply Money.